Hello and welcome back. We're going to talk about Baidu today. I have examined the company about a couple months ago, but these kinds of videos tend to become quite old very quickly. And so I wanted to give you an update, and also I was asked to make this video about Baidu, which I think it's a very fair company to examine. And as usual, we're going to be starting with outstanding shares here because they do tell us a story. And in this case, you will see that the company has been actually buying back shares for a while and then sold a bit back in 2021, I guess trying to take a little bit of advantage of the stock price, just make some money. And now they are buying back some shares again. Overall, I'm not too worried about this kind of picture here. I think it's okay for the most part. A little bit of buying, a little bit of selling, no big deal. So, what's going on here with the financials of the company? The thing that we can first see here is that the current PE is sitting at 27 and the next 12-month PE at 25, which is fair. It's pretty much where we'd want it to be for the most part. However, we're going to be still doing a discounted cash flow at the end of the video, just to see where it makes sense in terms of purchasing price. And we're going to move on with the income statement of the company. Just examine what they are doing here in terms of their income. Before we proceed, let me ask you to like the video if you do like this kind of content, because this helps a lot. And you may want to subscribe as well, because there's going to be a lot more content for you very soon. So, the year-over-year growth of the company is pointing to a company that grows at about 10 to 15% on average, I'd say, with a little bit of a slump over here in 2020. But what about the net income? The net income here, you will notice that it is actually decreasing, and it has been increasing for a while, and then it went really south in 2019, and then 2020 picked up again, and now the last 12 months it's less than what it used to be, 2.1. So it's not steady over here. That's something to notice in terms of net income. But what about the balance sheet? Is it strong for the company? So the two things that we are really interested about when we're looking at the balance sheet is the total liabilities first, which grew from 18.6 to 24.7 billion over here. But then we have to compare them to the total equity of the company, which is currently sitting at 34.8, which is more than the total liabilities, and that's fair. Now remember, this value is going to be $25 billion for the total liabilities of the company. And the total liabilities have to do with everything. It could be cash, like loans that the company took, or for instance inventory that they haven't paid for, a lot of things really. It's basically debt, not only cash, but any kind of debt. So the cash from operations here for the company from 5 billion to 3.7 billion, it's going down a little bit, and this kind of makes sense for the company to have lost quite some of its stock price actually in the last few months. So this is why they probably haven't been doing that great lately. So their cash from operations is going down. Cash from investing, so they do invest in market securities, which, as I have mentioned in previous videos, I like to see, as long as it's coupled with investing in business as well, because having a fund manager is okay, but I want to have somebody who's actually caring for their business. And that seems to be the case here. And the cash from financing, the company over here is actually issuing some long-term debt, and also repurchasing common stock. So they do think that their current stock price is low, and this is why they have initiated stock buybacks. So that's interesting. We're going to examine that and see whether that's a good idea for them to do that, because you want a company to be buying back their shares when their shares are actually a good value. You don't want them to buy overpriced shares, even if you're an investor in the company, because they could use their cash flow for better reasons really. Free cash flow here from 4.3 billion going down to 2.9 billion. So it has been suppressed here, as you would expect based on what we have seen so far. That's worth noting. It's actually going down. And the multiples of the company are sitting at very low levels here, 2.2, 2.8. That's fairly good over here. I like that. And the profitability is rather low here, 5.39. Now that's on par with other similar companies, tech companies that have, they're not similar, but they have like relatively low return on equity, like Amazon does, or Alibaba also does. But again, they are not the exact same space really. But still, I mean, this return on equity is relatively low. We probably want something a little bit better here because we need the company to be investing our assets and debt in a better manner and gives us more for our buck here. So that's not great. The solvency ratings here and ratios are pretty fair. 43%, I think it's pretty average. Total debt to equity, I'm fine with that, no big deal. So the picture is looking just fine here. So the next thing that we're going to be doing to determine how much we should be willing to pay is use this cash flow model that I have created. And I have actually run this model as well as another model that I'm creating with an application that I'm gonna be publishing soon for the for the subscribers of the channel and the viewers, and generally use it for my analysis. And it's the application that I have written basically is much more involved and uses cash flow margins, net income margins. It's much more involved in determining the price of the stock, the intrinsic value of the stock. But this one is actually only looking at the free cash flow and its growth. And so when I ran my model, it was a little bit higher. It was about maybe 15% higher than what we're going to see here in a little while. But again, this is something that's upcoming. It's not there yet, so I cannot really show it. I'm still working on it. Just wanted to mention that from what we're seeing here, you could potentially add 10 to 15% extra and be fine with it. So what's going on here? We have actually copy-pasted the values from the free cash flows over here. And you will see that the average free cash flow growth is negative, of course, because it's been going down. Now, we don't really want to be using negative, right? Do we? I mean, I suspect that the company will keep growing from here. I don't expect them to, to keep losing free cash flow over here. So I'm still going to go relatively conservative here because I don't know how the company will be handling their free cash flow in the next few years. Now, what we could do here is take a look at what analysts mention and use that in our calculations, potentially. But I guess it's a little bit out of scope for this one. This is something that I am contemplating to do on my application, though, just to give you the analyst estimate so that you can potentially use it for your models there. But over here, I'm just going to go with a relatively conservative value. So I'm going to be using a free cash flow growth of 7%, which is generally speaking conservative, but in this case, it may actually not be very conservative because the company has been losing free cash flow over the years. Now, because they have been losing free cash flow, I don't think this pattern will continue the next few years. So I think that an appreciation of 7% a year is very likely, and it could actually be even more as we are exiting the Chinese slump for some stocks and industries and all that. So I think this 7% for the next 10 years is probably okay to estimate with. The discount rate I'm going to use is 13%, which is what I want to be making out of my investment a year. And the perpetual growth rate, I'm going to use 2%. 1 or 2% is fine. And you will see here that the price per share to pay today for this and numbers over here is 108.3. And the company is sitting at 162.04 over here. In my application, this would probably be around 130 or so, maybe 125. And if you use a free cash flow growth of 10%, you expect the company to be doing a little bit better. You're going to be getting $132. And again, we are at 162 right now. So I think it is a little bit expensive as it is right now. If we want to be relatively conservative, I'd probably go with a 7 here. So I'd like to potentially get this. Again, I'm going to be adding like 15% because my other model is a little bit more accurate. So probably at around $120. I think it's a fair value to get it right now in order to get this kind of growth and this kind of interest for your money, really, 13% gains a year. Now, if you go with 12% gains a year, which is something that you can use, it's 12 to 13 is what I like to use. Now you're getting on a 120 over here, and the free cash flow of 10%, you are getting a $148, creeping a little bit closer to the current price of the stock, I mean. And so you get an idea of how this works and how we can calculate what we want to be paying for the company. And in my opinion, this is a very, very interesting company and potentially very interesting buy. But I would still want to get it at a little bit of a better price. Although I do think that they're gonna be doing well in the next few years. It's just a little bit expensive for my taste as it is right now. If it was around this level over here, and it was at some point, and it could still go down. I mean, it's very possible in this kind of market, of course. It has already lost a lot of its value. Look at that. It used to be 100, 350 something. And when it reached this level over here, actually this is an amazing level, like 96 or 100. I'm buying it all day. But even around here, like 130 maybe, if it actually goes down, which is close, because we are currently on 162. So if it reaches these levels, 130 something, I think it's a very, very interesting buy, actually, to tell you the truth. And I would look myself to potentially enter the company, the stock, if that happens. Right now it's slightly more expensive than what I would want, even though their balance sheet is pretty nice and their price to book ratio is very low, so that's good. They have some good stuff going on for them, but I'd like a little bit of a margin of safety for the company if I am to add it to my portfolio. So yeah, I could have bought it a little bit earlier and grab a little bit of a better price. This was actually a couple of months ago when it was 140. So it could happen again, who knows? Although they beat on revenue estimates, it may go down at least for some time now. Go up, I mean. So that's what I wanted to talk about in terms of Baidu, a very interesting company. It's something to have in your shortlist for sure, and maybe it deserves a place in a position in my portfolio really. And I will be keeping a close eye and see how it moves in the future, and maybe have another video later on. But again, my final thought is that I like the company, I like how they're doing, and they have some suppressing free cash flow and revenues and all that. I don't think that will continue, and also this kind of suppression actually is giving us a better price over here, is actually decreasing the value of the stock, and so that gives us potentially nice entry points. And yeah, for anything near 130, 140, I think I would buy this one. So thank you for watching, and thank you for the suggestion from my subscriber to take a look at this one. Very, very interesting company. And hope you enjoyed this video. If you did, please leave a like. And if you're not a subscriber, remember to subscribe, because there's going to be a lot, including letting you know more about the application and giving you access eventually. It's going to be great, I promise. So thank you for being around, and I'll see you in the next one. Bye-bye.